Last two were terrible? I didn't think the last two were terrible. Harsh.
Welcome in, guys. It's another Sunday slash Monday if you're in Asia.
Four
Uh,
was dope.
let's get started here. There's obviously some data that I think would be insightful for everybody, so I'm going to share. Also, this week and heading into this next window period until June 18th, you're going to see basically a lack of communication from the Fed because they enter a blackout window. I think that blackout window starts this week. What that simply means is that you will not hear from the Fed until the FOMC meeting, which is, I think, 18th of June, if I'm not mistaken. But that should be the dates. Okay, so let's get into things today. Now, first things first, as usual, I'm going to break through all the research that came in through the weekend, stuff that I found interesting. Um, Actually, before I even share this, I just want to kind of give you guys a retrospective of where the market's been this year so that you can kind of understand things. So, if you go back 2 to 3 months ago when we were talking about the fact that buybacks were not part of the market structure yet, because companies were forced to still kind of hold back on buying back when their buyback periods were not open. That kind of inadvertently muted the market a little bit, contributed a bit to the Trump crash, etc. But since then, if you look at the year-to-date performance of the S&P 500, right, you'd realize the best performing sectors, none of them involve tech. Tech is at 2.1% for the year, actually, which means a lot of this move that you've been seeing, right, this entire move, though some tech has been bought, majority of the move have come from other sectors within the market, specifically financials, which last week was on fire, utilities, because people have been positioning for bearish activity, fund managers as well, right? And you've been seeing some inflows into industrials, communications, consumer defensive. This one mainly led for communications, mainly led by Meta and by Netflix, right? And consumer defensive has been net bought because of recession fears. So portfolio managers have been chasing all of the safer and less volatile returns for the beginning half of this year. But now the thing is that the market has moved all the way back up close to all-time highs, and people are waiting for some form of a dip opportunity for then fund managers to accumulate and then head up for the next rally. So now, obviously, there's a very good possibility that, they may be right if they keep betting on this outcome. But though, if they have been betting on this outcome for the past 2 months, they've been losing money, right? Because the market's moving sideways and up. It's not been moving sideways and down. This one drop over here was all they got. And so now, with volatility being within the comfortable levels of 14 to 17 in this area here, where it's going to start to approach, you're seeing that the volatility in the entire market has started to just crush, which I already mentioned 2 months ago, that will now be the reverse problem. It'll be no volatility at all, right? So as a little bit of a look back as to what these bigger institutions are doing, right? If you look at stuff like this, so you can see they're selling put spreads below strike price. That means they're capturing credit on the bottom side of the price action, right? Credit, they're taking the credit on below support levels. There are some ratio put spreads for obviously specific equity positions. Then you have people still buying iron condors, right? This for June 6th, so this is likely over already, but iron condor is that's something that takes advantage of when price action is moving sideways. Okay, you sell a call credit spread and a put credit spread to get premium here and get premium here while you're waiting for price to move sideways. So there was more of that put in last week, but likely to be expired already. And then you have put spreads across the board, more iron condors, etc. So the price action has not been substantial in providing information that we're going to get a directional move just yet. Okay. Though I'm going to show you more flow in the golden flow later that might or might not give you a inkling that something might happen in July or August. Okay. So having a look at that, that's just where you are. Now, remember, as I mentioned, so if you look at the year-to-date performance, technology is only plus 2.1%. If you look at the 1 year performance, year over year now, okay, technology is at 17.9%. The biggest leading sector is actually financials, followed by communications. And so you can see how it differs if you go into 1 year. And if you go into the past 3 months, then technology is actually the most bought at 9.4%. Okay. And this is mainly because after the Trump tariffs thing happened, buyback windows came back. And then on top of that, you had the possibility that people were thinking the Fed will cut interest rates, right? Remember that portion when we were talking about it multiple times? Well, yeah. So now let's have a look at where we are currently, right? So if you look at the 1 month and 1 week performance, you'll see technology is still pretty up there, one of the better performing sectors. And so in the last week itself, tech and communication services were the better performing sectors, right? So you can see that now there is a real desire for some of this capital to flow to other sectors because for the past couple of months, right, they have all been running pretty hot. And that brings me to this week's assessment and kind of like view of things, right? Which don't forget, this week you have CPI, okay, on I believe Wednesday. Yes, Wednesday. Okay. You have CPI on Wednesday. You'll have initial jobless claims again. You'll have PPI on Thursday. Okay. So this will give you more information on inflation, right? And then inflation will also build into the Fed's narrative of interest rates, as well as the Fed's narrative on unemployment, which will be two of the more important gauges that we are watching. Okay. So remember, unemployment rate and the inflation rate is what we look at from macro terms in order to figure out where the Fed is going to be making its decisions. Okay. Now, having said that, very quickly, let's look at the econ, you know, rate chances and that show as a wang, right? So in June 18, you can see June 18 decision. If I don't know if the Fed is actually meeting in June. I'll have to clarify this because it's a blackout window. So they might not be meeting in June. I do not know. But in July, the chances for a rate cut is close to none now, right? You remember when there was a more than 50% chance of a rate cut? Do y'all remember this? If you remember to say yes, right? And also remember when we had a possibility of a secondary rate cut in September, and now that's dropped to almost no possibility, right? No possibility. So here, the first rate cut now is being priced in for September or October instead. Okay. And this is kind of goes in line with what I've been talking about for the past couple of weeks, where I told you guys I feel like there is a very low chance that the Fed can cut interest rates, even till December. It'll be tough, right? So if you look at what the Bloomberg terminal is pricing, or rather what it's showing on the Bloomberg terminal, you can see that the first proper rate cut, sorry, is only getting pushed to October now. October 29th during the Fed meeting. Before that, there is a very low chance. Like, yeah, there is a possibility here in like September, I guess, which is aligns with what we just looked at. But it's a 51% chance. Okay, here it's a more higher percent chance for whatever reason based on the credit spreads. Okay, so other important things is last week, hedge funds were aggressively buying healthcare and energy. Now, both of these sectors, if you look at them, they're not terrible in terms of risk to reward ratio. Okay, healthcare, right, with its kind of very sharp sell-off, now potentially like finding a temporary bottom. This is not a bad idea only if you know how to trade this setup and take the risk assignment based on a swing trade, right? You would have to, of course, wait for higher highs to be formed above 136 on healthcare for you to kind of move up, bounce back down, and then we can take a potential entry, right? To confirm that this is indeed a level of higher demand here and where buyers are stepping in, right? We want to see buying action in this area. But if you don't see that buying action, I wouldn't take a speculative bet to just go long without seeing the confirmation. Okay. That's one thing I would say that's very important. Don't just go take long just because you saw that hedge funds went long. Remember that following hedge funds is the easiest way to blow up your account because they are usually effed most of the time. Okay. But they have been buying. So that's just one thing that you need to know. Okay. It's a piece of the puzzle. And if you look at inflows, right, which we look at every week, you can see sector-based inflows now. Last week, it was more of the same. We saw the same three culprits with outflow and then massive inflow for the rest of these, right? Which that's pretty normal. So right now, in the past 5 days, there was mini outflow from utilities, mini outflow from materials, mini outflow from consumer services, communication services. And a lot of the money has been shipping in the past 20 days into energy, into single stocks, into all US equities, right? You can see that. Infotech is also kind of decent flow, right? And tactical sentiment is back to the red now, right? A little bit overbought, but remember it can stay there for a while. Okay, now, as I was mentioning, buybacks, very important. Many of you don't follow this, but Copper America buys $1 trillion worth of shit back every year, almost now. So you better be paying attention because that's a lot of money, right? You can see that financials flow decline as they start to enter blackout ahead of earnings in July. And generally, the first set of corporate release earnings will be within the first 1 to 2 weeks of July. So the blackout period estimates between 4 to 6 weeks prior to earnings and ends 1 to 2 days post earnings. So that'll be approximately from 16/6 through 7/25. Okay. And July tends to be the slowest month of the year for buybacks, but then picks back up in August. Okay. So you can see here that buybacks tend to be the smallest in August and then picks up again it tends to be smallest in July and then picks back up in August. Okay, now what about the estimated volume of buybacks? Well, have a look at this. So these are the announced buybacks for the year. You can see Infotech obviously leading the way massively with 100 and I want to say 50 billion, right, so far. That's approximately 2% of market cap, which is pretty decent. Financials right behind with around 130, 140. And then you have communication services with approximately 60 or 70 billion. So these are all your mega caps buying back their own stocks, right? And then the rest of the sectors are kind of negligible if you think about it. Very small amounts. So having said that, all of this is going to cushion the market if drops do happen. And that means that in this month, since the buybacks are not as strong, maybe you might see that because in this specific month where June, July is of concern, you might see lesser protection in July, which means in July, there may be a possible attempt at a pullback from the market. Okay. That is also the time in which you'll be in between earnings periods. And you guys know what I always say, that there is a period of time right after earnings of all companies are done, before the start of earnings for the next period, where the market moves. There is a 2 week window, or sometimes a 1.5 to 2 week window, where the market usually moves because there is rolling contracts. People are managing exposures. People are repositioning themselves ahead of the next earnings season. And all these analysts will come up with new price targets that will move the market during that time. Okay. So that period is coming now in the next 2 weeks or so. So I'm putting this all in front of you so that you can be prepared of it as you head into that season right now. Okay. The market will move in the next couple of weeks. We do not know exactly when. If I knew, then I would not be here telling you this information, right? But we can guess during which period roughly. Okay. And so this week through 6/13, the S&P 500 implied move is 1.91%. Apparently, there are a bunch of conferences going on this week with a bunch of jobs related stuff that's happening. And if you look at sector positioning from the Z-score standard, which is standard deviation, and I hope that this loads, you'll see mega cap and growth is still recovering here. I spoke about this last week where tech was down there, right? Financials are down there and recovering as well. Energy is recovering from a downtrend. Consumer cyclicals, I wouldn't touch this, it's in the middle. Industrials also recovering from a down, right? Materials, same thing. Consumer staples, wouldn't touch it. Real estate, getting a bit attractive. Healthcare, very attractive. As I mentioned, healthcare was very attractive last week, right? Last week, healthcare and the other sector was, I believe, energy were two of the ones that I mentioned, right? And which is what hedge funds bought last week. So that was, and then you also have small caps, which I also mentioned IWM multiple times now at this point, right? So you can see how all of that plays into the price action. All these reports are available on Discord, right? Okay, now let's hop into the finisher technical slash macro dashboard, right? As you can see, nothing much has changed here. Last week we had a little bit of spike in repo activity, a little bit of just, flux of cash inward. So far, non-farm payrolls have been pretty standard coming in. No real changes, to be honest. Not much spikes and whatnot. But M2 money supply, right? The volatility of M2 is coming back, this is great, right? So M2 money supply, you can see we're currently sitting back to the highs. Okay, so money is pulling back into the system through the Fed overnight repo rates and whatever other functions of balancing that they're doing right now. And so money coming into the market is good for the market, or rather, it lowers the effective interest rates for everybody, which typically is a good thing. That supports equity pricing. Okay. All right. So Bitcoin broke all-time high, created this little peaky, and then has come back down. Is still kind of respecting this bounce zone where it came out of, specifically broke out of. And we'll have to see if it can actually form a longer term base here, because what I feel is you might form like a very big sideways bull flag before the next break up or the next break down. Okay. So expect, but risk taking here has been pretty good, right? Chinese equities. This has been performing very, very strongly for multiple weeks now at this point. Look at how many weeks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks. For 10 weeks, the Chinese equity market has been green. We are about to surpass the highs we got at the previous, rally. So this is another piece of the puzzle that not many people might be paying attention to, but you should be. And then let's look at SPX slash SPY technical. So if you look at where we are in terms of technicals on SPX, you'll see right now the price action is back exactly to where the DeepSeek fears were announced. This is where the DeepSeek fiasco was announced. Okay, we're literally back there now. After how many months? 1, 2, 3, 4 months later, the market went down for a quick 20%, 25% crash slash correction, and then came back up, back all the way to where we were. And here is where we are facing a lot of overhead problems. In fact, this 6,000 level on SPX is being very, very stubborn. And I'm guessing it's because there are a lot of people that just don't want to take additional risk upside here. But let me tell you that if we break the upside, it's going to be absolute chaos, because what's going to happen is as we break the upside, all of those fund managers that were expecting a pullback, they're going to start chasing this upside. Okay. And that will cause another squeeze in the market, like how I had predicted back when we were down here, where I told you guys that we are likely going to squeeze in this positive gamma environment where market makers will also be forced to hedge by buying shares. Okay. And so right now, where we're at, 6,000, or I want to say on SPY, it's probably 600, right? I'm just going to use an even number because it's so much easier. 600 is your very important key pivot for this week. Okay. If you can close above 600 and have momentum slowly pushing up against 600, then all-time highs at 610, 615 is very possible during the period in which we are approaching a new earnings season, which means in the next 2 weeks or so. However, if we reject the 600 level and we are unable to break this level down, then there is no incentive for anyone to buy this positioning up. So if we reject, or if we break out and then reject, that will likely cause us to fall back down to 590, or because 590 was the biggest level from last week, right? Or 580, which would be the next level. Okay. So that'll be the two, or rather three levels in which I'll be watching for this week. Okay. And the same thing kind of goes for NASDAQ, though it's in a little bit of a different situation. So if you realize NASDAQ's already broken past that resistance zone when it was down here, and it got that demand. You can see these peaky legs, sexy candlestick legs that showed us that price action was still aggressive to the upside, right? And so here we'll need to break above 21,900, which is the key level, the 38.2 Fibonacci extension. And that will then give us all-time highs at around 22,375, which will then push this up into here. Similar case with the SPY. Now, look at small caps. Now, I don't know if any of you remember this, but last week during our call, I had mentioned that there will be two sectors that will benefit from a rally that is underbelly and happening in the market. So two sectors were software tech, or tech with high beta, right? In other words, growth tech. Things that are beaten down from interest rates being high, stocks that have been forgotten, right? And the proxy, which I was explaining you guys, that you can use for such stocks is ARKK, the ARK Fund by Cathie Woods. And you can see what happened to this fund in the last trading day of the week. It was up 8% because the entire basket was squeezing, right? Now, what are the stocks that make up Cathie Wood's ARK Fund? Well, you can see you have Tesla, Coinbase, Roblox, Roku, Palantir, Robinhood, Tempest AI, Shopify, CRISPR, Archer. Tesla was down last week massively. How did the ARKK fund actually manage to return more than Tesla dropped, with Tesla being 13% of its portfolio? You have to ask yourself this question. Well, it is probably because there was immense buying in all of the rest of the other pockets within this fund. So this is the type of analysis that you kind of need to reach and conclude on your own. You have to learn to do this stuff because you have to understand where capital and liquidity is flowing in order for you to kind of get a good idea. So growth tech has been bid last week. Does that mean that it's automatically bid this week as well? No, it does not. What I'm trying to tell you is you should probably be looking at that sector though and having it on your radar, because there are probably a lot of fund managers that are underexposed to those names. And if this market breaks into all-time highs, guess what? It's not Mag 7 only that they'll be buying. They'll be buying everything. And the things that have the best risk-reward ratio are the ones that have been beaten down in these specific sectors. This is the reason why I think that people are front-running and buying this sector up, the growth tech sector, right, ahead of this period that is about to come. Okay. So in terms of technicals, that's all. In terms of macro, let's just once again very quickly go through the 10-year yield scenario, which once again last week saw bids come back into the yields, which means people were selling bonds, which means that quantitative tightening was now on the table, which we did see in the data, which I just presented to you, because the rate cuts have been pushed back to September now when it was in July, right? And so now the market's pricing back the rate cuts to a later part of the year. And I've already mentioned this multiple times now. if the Fed can cut rates this year, I will be very surprised because the economy is still very strong. The job market is still very strong. They actually have no reason to. If they really want to push a Fed rate cut, it'll be the end of the year, right? By December, maybe. But right now, I don't see the possibility of that happening just yet. Okay. And so here now, you can see that the likelihood of when the yields are moving up like this, you can see the likelihood of quantitative easing becomes lesser, right? So if yields can kind of come back down below 263% here, then okay, I'll be, kind of like agreeable to say that okay, we might get a rate cut, right? Sometime by the end of this year. But as of right now, it doesn't look like it. Okay, the bond market's singing a different tune altogether. And the dollar at the same time is moving lower, right? There's a possibility that we move even lower on the dollar. And the lower dollar moving is not good for the US economy actually, but it's really good for US stocks because then more investors will pile buying US equities because it's a better price for them. Cheaper dollar equals cheaper investment equals better returns. But this is not overall good for the US economy because when cheaper dollar happens, that's kind of a devaluation of your own currency. The US will have a tougher time with its FX positions and its FX swaps that they have. Okay. Okay. So that's about it I have for you guys today. I'll hand it over to Andrew, but I hope this covers majority of the stuff. Remember, three things only you need to be aware of. The first is that 600 on SPY is one of your bigger levels for this week. Okay. You'll have to watch that like a hawk. If you break above and you can hold above, and for some reason there's strong momentum, we will push very likely into all-time high or against all-time high, where then you have a chance for a double top, triple top, quadruple top, whatever bullshit thing. Or if you don't break 600, then you're rejecting further back down to 590 or 580. These will be the two levels that you will have to keep in mind. Okay. So it really isn't a difficult week this week. You just have to be patient. Of course, the upside here, if you're day trading, then you'd have to adjust your risk profile. The downside for a swing, probably, since VIX is so destroyed here, I would, instead of taking SPX or SPY puts, I would rather go VIX long through like a spread situation where theta is not eating into your contracts, and at the same time, you're going to be looking for multiple months out. So like maybe a July, August kind of VIX spread or a July, August VIX call situation where you're not paying full price for the call, okay? Where you're using a credit to offset. So yeah, that's all I have to say for this week, and I'll hand over to Andrew now.
All right. I'm going to echo a lot of the same stuff. So just with some different data to back it up. So let me just load everything here real quick. Here we go. All right. So, like every week, we're going to recap last week, and we're going to talk about what things changed within the data going into this week, and then we'll get into your guys' questions about everything. So, real quick, who can tell me what was the level last week that we said pay attention to?
590.
It was 590, right? So let's take a look at the price action because I just don't make up these levels for the fun of it. So, Bougie, you're ruining my second. Jeez. Um, so we can see here 590, a lot of activity, candles closing below 590. We said if candles start to close above 590, we look for price to push to 600, right? And so you can see here, first day we had a great push up into about this 593 area. Nice rejection, comes down, back tests 590, buyers step in right at 590, pushing price all the way up into 598, where then you got this little news segment that came out between Trump and Elon and all of that fiasco. And then sure enough, the next day, we're right at 600. So very smooth week and exactly as we expected. So if you went long over 590, then you had a successful week. And And if you played for the target, then you hit the target. So with that brings us into this week. So let's get into the data here. So if we go into the playbook here, there's a few things that I want to point out. The first is the month that we are in, right? So the algos aren't really showing much, so I'm not going to go through them too much. I mean, you can look at them if you want to, but there's not a lot here with the algos to look at. A little bit here on the monthly, but again, not a ton. Start here with the NAMO. So if we look at the NAMO is a little overextended to the upside, which would mean probability is to the downside. Okay. So little bit overextended over here. So the probability is now a wave to the downside. If you kind of go back to last week, right, and we look at the NAMO last week, very different on the short term. So you can see right here, right, it was a very different setup. You were a little overextended on the downside, and we were looking for that move to the upside, right? So that played out as we expected, okay? Remember, little things within the playbook, I call them breadcrumbs, to help you guys kind of understand what you're looking at. So the NAMO, a little overextended on the short term, would lead to potential move to the downside. 1 second. If we look at the Nazi is pretty extended. We've had this big, strong move here, and I kind of call this indecision. We're not really getting clear direction. It's kind of just flipping back and forth based on how the day goes. So we're waiting to see some consistency to see if that's going to hold or not. So not much there. So then we go into seasonality. Now, if we look at June, June historically is not a very strong month. You do have this kind of high that you put in, maybe a liquidity sweep, and then into the back end of June, into your quarterly expirations, you get a pullback, right? So that's one thing to keep in mind. Now, if we look at this price action, right, a high, then you take that high out, and then you have this pullback, it looks pretty similar to kind of what we're looking at here, right? You have this high, then you have this pullback, then you kind of take that high out. Maybe it goes higher, who knows, right? But you take this high out, and then in the back end of June, you have this pullback. Now, I'm not saying that's going to happen. I'm just saying based on seasonality and the way the price action looks right now, it's pretty similar to what we see on our normal seasonality for this month, right? So just something to pay attention to. And then again, if you look at seasonality wise, June is not a very strong month. July is. And so you just heard T talk about, hey, I think into July or August, we could see a nice rally. And if you go back to seasonality, that's usually what you see, right? You get a drawdown into the back end of June and you get a strong month of July and even some upside here from August as well. So again, if we get that pullback in June, could be a nice opportunity to go long into August. Definitely something we're going to be paying attention to. If we take a look at like dealer environment, it's not much. We're still in positive gamma. We're still in slightly positive deltas, but again, it's kind of flipping back and forth, similar to the Nazi, so not much there, which is kind of a sell the rally environment. Again, not huge exposure there, but it is there. The main thing to watch here that's going to make this week really simple is the 600 level, right? So if we look at 600, this is all expirations. We can see clear as day that it is the largest level of exposure, which means dealers are short 600. So if price can get over 600, we'll be looking for dealers to have to buy shares to hedge that risk, right? So let's go back to the visual that I always use for this. You go to pin messages, you go into here, and you pull up this visual right here, right? So if the dealers are short, right, whether they're selling calls there or sell, I mean, or longing puts there, either way, if the price gets over that level, they have to buy the underlying asset to hedge that risk, right? So the investor or the whale is long 600. The dealer has to sell that position Therefore, they have to buy shares to hedge that risk, right? That's why we call it buying pressure. So if we can get over 600, then we'll be looking for that push to the upside. The second thing is if we look at this week, which is 613, we can see that there's a little bit of buying pressure, not a ton, but a little bit of buying pressure at 598. So not only do you have buying pressure coming off of 600, you also have weekly buying pressure coming off of 598. So you have two levels that market makers would have to hedge. This could create a short squeeze on the market, which goes back to what T just talked about, which is fund managers being underly exposed, right? They don't have the exposure to the upside that they want. And if this happens, they might have to also grab some exposure to the upside, which then could create a short squeeze on the market. So if we look at kind of this week's breakdown, it's very simple. Last week went exactly as expected. We had our first, we had first noticed a large buildup of resistance at 590 as dark pool activity had signaled. Price first came down to sweep liquidity. Then once it broke 590, it was gone with a great push to start the week. We then came back tested 590 level, which gave us confirmation and a strong move up into 600, our weekly target, as well as our biggest gamma level. That leads us into this week. So far, seasonality looks pretty spot on. And with the NAMO and fear and greed hitting the market, might be a little overextended. The nice thing about this week is the levels are very clear, 600, 600, 600. So just like last week, where we said 590 over and over and over again, 600 is that level. 600 is the largest gamma level for the 620 contracts and is where the dealers are short. That means as price breaks over 600, dealers have to start to buy shares aggressively to hedge that risk. As dealers buy shares, this will start the squeeze. The stock market, as we push up into the 605 gamma, if we can break 605, there's a good chance the buying pressure from 598 contracts and the 600 contracts will drive price up into 608.31, the bullish weekly move, or even up to 610, which is a gamma level. On the other side, if dealers do not become buyers over 600 and we continue to reject this level, it will signal that dealers are not going to buy to hedge, and we will watch for price to fall below 598. This would mean dealers have no action because they are the ones who are short 600 as well as 598, which means buying pressure could die and price could fall into the 1 hour GP for a nice retrace and hit 589.77, our bearish weekly target. If price breaks below 590, we could see more downside as the back end of June is usually pretty bearish due to quarterly expirations. So pretty clear breakdown there. If you guys haven't read it, make sure you do. Now we can look at the actual price action, right? So if we're taking a look at this and what we're looking for, we can see that these 4 hour candles did not close over 600. So very simple evaluation. We're looking for candles to close over 600 to push through this dark pool level, which is a 21 billion area, up into this 605 level. If we can break this 605 gamma, we're looking for the buying pressure from here and here to push us up into the weekly move, which would be 608.31, and possibly up to 610, which is our gamma target, right? Maybe we go to all-time highs even, who knows, right? Now, if we cannot get over 600, we continue to come down here and reject it. That would tell us that the dealers are not buying shares here. They are holding the price below 600 as they did last week. If that is the case, the price might get pushed down. Therefore, you lose buying pressure here and you lose buying pressure here. Price then could just fall into this order block down here, which is in the low 590s, and potentially into our 1 hour GP, which is down in kind of this 588, 587 area. If you break the GP, you would come all the way down into the low, which would be down into this area, which is kind of the 582, or even potentially down into the 4 hour GP, which is like the 580-ish area. So that would be the other side, which would fall in line with seasonality, right? If we go back to the seasonality chart, that would kind of fall in line with what we're seeing here from a seasonality standpoint. Now, the seasonality piece that we didn't talk about is that normally in June, you can sweep these lows. So if that is the case, this would come all the way down, sweep those lows, and that would be a great buying opportunity going into next month. That is what we hope happens. Is that going to happen? I don't know. That's what I hope happens. Gives a great buying opportunity for next month and a nice way to position ourselves for a great move. So we'll see what happens. Main thing to watch for is the 600 level. If we can get over 600, I'm looking for more upside. We stay under 600. I'm looking for downside into this golden pocket or essentially just the weekly target. So with that, I'll open it up to you guys and your questions, and we'll wrap this thing up. I do 4 hour, but I know you guys are impatient and want a day trade. So 15-minute, I would say, is a possibility, but it's not going to be a strong confirmation. So, for example, if you're looking at this, you can see these 4 hour candles all close below. This 4 hour candle closes above, and then never once does another 4 hour candle close below 590. So now if you wanted to use a smaller time frame, you could use a 15-minute. You got to go all the way back. Here's your 15-minute. You can see, sometimes there's some manipulation here. Like this would be like a liquidity sweep situation. For the most part, the candles kind of close below. Then you kind of get some like wishy-washy here, and then you get your breakout. Um, if you're day trading, I use a pre-market box. So for example, this would be your pre-market, and this would be your box right here. And so you can see that price liquidity sweeps, as I talk about in the plan, price comes down and liquidity sweeps this, which is also in line with this wave right here, right? In your golden pocket. So this wave right here, this is your golden pocket, kind of comes down into this area, liquidity sweeps to kind of kill the 15-minute orb for all of the Furu traders. And then it comes back, breaks the 590, and you get that push into the back end of the day. So again, I think it depends on the individual. For me, I use 4 hour. I have multiple positions. I have leveraged shares, I have options, I have um, inverse stocks. It just depends. I don't try to time the market. I'm not playing, a weekly contract. I'm not trying to, if I am playing a short dated contract, it's usually a hedge against a larger position. For example, like if you hedged Tesla last week, your hedges are up, 1,000, 2,000, 3,000%, covering a huge chunk of your equity loss. So again, just depends on how I'm looking at that position. There's multiple positions that I have to manage. Hence why I don't tell you guys all of my positions. So I think, however you guys want to use your time frame. Here's another pre-market. This is the box, right? So your pre-market box would have been here. And then this would have been your low right here. And so there's your candles closing above the pre-market range. This is a 15-minute candle. And then you had a nice little push, right? So again, using the pre-market price action to kind of Identify where potential breakout is. Here's another one, but this one we didn't go anywhere. So here's your pre-market price action. And you can see the whole day just spent the whole day inside the pre-market price action, right? So this is that one day where like you could have just played the range all day and you would have had a fantastic day. Um, that one's kind of nothing. Then your next day is here. This obviously happened pre-market. So this was kind of your pre-market range here. You had this pre-market move up to 600, in which you can see that after that push, you never once came over that box. You had a big sell-off here. So you could have gone short and used kind of the high of the box as your stop loss, and you caught the move. And then same thing here, right? They liquidity swept the lows. They go back into the pre-market range. You could have gone long here and then played the move to the top of the box. And then same thing here again. Pre-market range enters the box, goes back down. So this is just chopping back and forth, just sweeping people's stop losses, right? That's why I like the pre-market range. And then here, this was the best one, right? You had your gap up, you had a super tight pre-market range. I played this one live with you guys. So this one you guys should have caught. Nice move here. Pre-market goes all the way up to there. We stretched the box out. We would have loved for it to stay that way. We stretched the box out to the open. It just breaks out off the open and pushes up into 600, right? Obviously, it's not going to break 600. I didn't think it was going to break 600 at least. Maybe you guys did. So, okay. The AMD trade. Okay, let's go over the AMD trade. What are the targets for the AMD trade? Who remembers how long that position is? Exactly. So, how many of you guys think I'm looking at AMD on a regular basis? Not. I have this and I look at this. Where is it? Right here. Monthly target 122, downside 99. Hedge the downside to 99, and I plan for a push to 122 by the end of the month. That's it. And then after that, on to the next month. So if you look at AMD, it's pretty much at the 122. It's at like 120 it hit. So like it couldn't break the 120 level. Still just trading inside this box. So your, volume profile in here is right there. So it's slightly above the volume level right now, your point of control. But it's not doing anything. So I'm not really too concerned here with AMD. Now, on the longer term, it did bounce out of the golden pocket. Right? Let's get rid of the small one right here. On the longer term, this candle closed inside the golden pocket. So, and now it's trying to break out of the golden pocket. So I still feel really good about this. If it catches some momentum here, it still looks really nice. But again, it's not a short-term move by any means. So, okay. Okay, you can ask this on hymns. Um, yeah, you're just in this box. This is your point of control. T usually has this volume all on the side. I just use this tool now. I just use kind of the area where it enters the consolidation, which is here, and then stretch it across, and you can see the volume is down here. So as long as it stays above this box, this low, this pivot, whatever you want to call it, it's fine. If it loses that, then you're looking at downside, right? You got a little pivot right there. And then clearly you can see this 62 level right here. We'll get rid of that. You can see it's also rejecting the high of the box. So I mean, just kind of consolidating right now. If it were to break the low of this box, I'd expect it to come down to like 37, 32. But other than that, I don't see much. Let's see. Yeah, nothing there. It's got some good exposure out here in the back end of the year, but good support down here, 56. If it holds that area, it could. Mm, 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 mm. So 37, 35, 50, 58. Nothing where it's at right now because it's at like 56 right now. So I guess you could say 58. Over 58 would be good. Your biggest levels are out here at 100, which is that flow I just showed you for end of the year. And then 35, which is where I think it squeezed from 35. It did. So that buying pressure was down here at 35. That was buying pressure. And so it's been squeezing off that since. A little bit of selling pressure at 58. But your next big level is 100. This would be a pivot because that's going to be all-time high.